Hello everyone. Welcome to today's webinar. Hope you're having a great Merry Christmas holiday season. Of course, as you can see, we are. Tell the production team that I'll wear anything that they bring to me on the day of the webinar, and here we are. So hope you can still take me seriously in my ugly Christmas sweater. Today we are going to be addressing questions from you, from our audience, and primarily having to do with year-end issues, right? What to ask your CPA, your accountant, at the end of the year, and what should you be thinking about? What type of questions do you have at the end of the year that you'd like answered? All right, so this is an interactive. We will be taking live questions, and you can submit your question through the chat feature, and tell us your name, tell us where you're from, and we'll get your question answered today, all right? We've got some questions that came in advance of the live webinar, so we're going to start with those. So, first question. I'm just starting out in my business. Should I get an EIN? Okay, do I even need an EIN? It's a great question for a new business owner. An EIN is like a social security number for a business. Okay, it's an employer identification number. If you are a sole proprietor, then you do not have to have an EIN. Okay, if your plan for now is to start a business and just go out and do business on your own as a sole proprietor without another entity, it's like an LLC or a corporation, S corporation, then no EIN is necessary. Okay, now does that mean you can't get one? No, you can still get one. They're free. You get them online at the IRS website. But you do not have to get one. You definitely will need one when you become an LLC, or if you organize an LLC or a corporation. Okay, so hopefully that answers your question. Let us know. Submit another follow-up question if we can help you more with that. Next question. What's the best way to figure out how much I should set aside for taxes and while running my business? Okay, so great question. This is really where Mazuma hones in. We know as a small business owner, you don't want to be wondering, coming up to the end of the year, wondering how much your tax bill could be. And so our goal is to make sure that you know what the tax bill is going to be and that you can plan for that. But maybe you're not using Mazuma, or maybe you don't have a CPA who can help you with that. So rule of thumb is, first you got to know what your profit is in your business. Okay, so we have an example profit and loss report here. Sales of 100,000, cost of sales 50,000, and then our expenses another 20,000, which leads us to a net profit of 30,000. Okay, and these are just rough numbers. You can drop a zero off or add a zero on depending on your situation, but you got to be able to get to this number, this net profit number, before you can tell what your taxes are. All right, so take all of your income minus all of your deductible expenses and arrive at this net profit. Okay, and a little word on that. Taking money out of the business yourself is not a deductible expense. Okay, if you're taking money out for you to put in your pocket. So you get down to this $30,000, or the net profit number, and then you're wondering how much of that should I put aside for taxes. And this should be done on a monthly basis, right? So that every month you're evaluating where your profit is, so you get an idea for how much to put aside. The amount of taxes you put aside depends on your tax bracket. So if you're a high wage, or if you're a high profit business, you're going to pay higher rates of taxes. If you're a low profit business, you're going to pay lower rates. But it depends is never a great question or a great answer, right? So general rule of thumb is 25%. If you're taking 25% of this net profit number and putting it aside for taxes, then you're going to be in decent shape. You may owe a little bit more, you could owe less, than that when all is said and done. But our recommendation, kind of not knowing the details of the situation, we suggest 25% of your net being set aside for taxes. And that includes, if you're a sole proprietor or an LLC or a S corporation, a pass-through entity, that includes both the business and personal taxes. Okay, so I hope that answers your question and gives you an idea of how much to set aside for your taxes throughout the year. Great question is a follow-up. Should I pay my taxes quarterly or just once a year? This is a very common issue, right? And I think it comes up, it's questioned so often because of the way the IRS has made it complicated for us. The IRS wants to get our tax money evenly throughout the year. So they want us to pay in our taxes as we earn it, okay? Just like a W-2 employee does. If you're a W-2 employee, you're getting a paycheck. Those income taxes are withheld from your check as you receive each check. And so the IRS is getting their money as you receive each check, right? As a business owner, no one's there to withhold the money from you. So the IRS has said, okay, small business, self-employed people, you've got to pay money in throughout the year, but not with every time you pull money out of the business. You need to do it at least quarterly. All right, so they set up these estimated payment deadlines throughout the year that allow you to do that. Now, if you let's say you don't make the estimated quarterly payments, all right, and you get to the end of the year and you owe $10,000 in taxes at the end of the year, and you haven't, and because of your self-employment income, and you haven't been paying in throughout the year. Well, when we prepare your tax return, we're going to show a $10,000 bill, and the IRS is going to be asking, did they make estimated quarterly payments? And if the answer is no, then the IRS is going to give you what they call a late payment penalty. Okay, this is the smallest penalty that the IRS has to offer, and it really ends up being pretty small. It's 0.5% of what you owe. Okay, so it ends up being very small. If you ended up owing $10,000, there's a lot more factors that go into it. You might owe $50 or $100 in penalties. But like I said, because there's some factors, they look at what you made last year, and they factor that into the calculation too. So if you want to avoid, the short answer is, if you want to avoid all penalties, yes, you should be paying your estimated quarterly tax payments. And you're basing those estimates by what your net profit is, okay, at those throughout the year. If, on the other hand, you need that money and it would be a hardship to pay it in, and you don't, and you pay it all at the end of the year, no one's going to come after you, but they will throw that late payment penalty on when you go to file your tax return, which is usually very small in comparison to how much taxes you owe. So if you want to avoid all penalties, pay it quarterly. If you're not worried about owing a little bit more in exchange for getting to use that cash during the year, wait till the end of the year. But always make sure there's something saved up, right? You don't want to go file a tax return and not have the money to pay the taxes. That's worst case scenario. If you're not going to pay it in quarterly, at least put some aside in savings, or make sure you're disciplined enough and you're planning well enough that you know you'll have that money when you need it. All right. Okay, hope that helped. Next question. I only pay taxes on money that I take out of the business, right? Is that right? Not quite. You pay taxes on this number, this net profit number. Okay, so, and as we talked about, this calculation of determining your net income, income minus expenses, does not factor in any money that you personally, as the owner, took out of the business. Okay? So the answer is no. You can leave the money in the business, all of it, and you'll still be paying taxes. Or you can take all of the money out and you'll be paying the same amount of taxes. That's the general rule. That's how pass-through entities work. Now the nice thing is that if you earn this money and you leave it in the business account and you don't take any out for yourself, you pay taxes on it now, but then you can take it out next year, anytime down the road, and not have a taxable event just because you pull money out. Okay, it's kind of ideal the way the IRS has set this up, that you're paying taxes on the money you earn when you earn it, regardless of when you get the benefit of it by pulling it out of the business. All right, so I hope that answers that question. Let us know if there's any follow-up there. Next question coming up here. Is medical insurance premium tax exempt? Sorry, is medical insurance premium tax exempt for joint filing? Great question. So whether you can deduct insurance premiums depends on if you're a business owner or not, one. Two, it depends on if you're not a business owner, it depends on if you're itemizing your deductions and how much total medical expenses you have. Let's start with the business owner. Let's say you are self-employed. All right, so if you're self-employed, you have a business, your spouse could be working, right? But you have a business. So one of you are self-employed. That qualifies you to take a deduction for your insurance premiums as an AGI adjustment on the tax return, which reduces your income dollar for dollar, just like any other deduction. Okay, so you get to take all of your medical insurance premiums as a deduction if you are self-employed. Now, mind you, if your spouse is working and their employer is paying for the health insurance premiums, then you don't get to deduct them. But if you are paying out of pocket for those premiums, then you would get to deduct them on your tax return. Even though this applies to small business, self-employed people, this is not a business deduction. Okay, it's not on the business portion of the tax return. It's taken as an individual tax return or individual tax deduction on page 1 of the 1040. But that's one of the great benefits of being a small business owner, is that you get to deduct it in full if you are self-employed. If you're not self-employed, the IRS says premiums are a medical expense and they're lumped in with all of the other medical expenses, all right, that we let you deduct as an itemized deduction. Now the problem with that is that medical expenses have to exceed, under current law, which this could change, but medical expenses have to exceed 10% of your income before they even start counting, before they're even deductible. All right, so it's very common that even all of your premiums and medical expenses added up will not exceed 10% of your income. All right, so a lot of times those are not deductible, but they are if they're big enough. So you might have had a procedure done this year or a family issue that came up that caused a lot of expenses this year. You definitely should add them all up, combine those medical expenses with your premiums, see if they exceed 10% of your income. If they do, you can deduct them, even if you're not self-employed. All right? Great questions.
Follow-up question, sorry, with this one. He's a W-2, his wife is a 1099. He was declined medical insurance through his employer. She signed up for medical insurance in the marketplace. So is that deductible?
Great question. So if you didn't hear that, we've got an individual who's an employee, spouse is 1099 independent. So that means self-employed. Okay, if you're getting a 1099 and you're reporting that 1099 income on your tax return, you are considered self-employed. and therefore you would get to deduct any premiums that you're paying out of pocket as a self-employed individual. So, and as a joint couple, you would get to count that as a deduction. All right. Okay, next question. Is there anything I can do before the end of the year that will save me taxes? Yes, there certainly is. The number one thing is, spend some money or buy some equipment to drive this number down. Okay, by prepaying your rent, by buying some supplies, anything that causes money to go out the door before the end of the year is going to drive this net profit down and lower your taxes. Even if you buy a car or finance a piece of equipment, if you're financing something, you get full credit as if you had paid cash for it. Okay, so the deduction is still fully available whether you pay cash or you finance it, or you put it on a credit card or you write a check. It's all the same. The deductions are still available to you for those items as long as you buy them before December 31st. That's the primary requirement. Now, the most important thing coming up to the end of the year is that you know where you're at, right? If you're flying blind and you don't really know what this number is going to be, then you're kind of handcuffed. You could be spending money when you don't need to. You could be worried about taxes when you don't need to be, or you could have a bigger tax bill than you think, and you don't know it, and you don't realize, oh, before the end of the year, I could do X, Y, and Z and invest in this piece of equipment that is going to save me taxes now. So most important is that you get your records up to date so that we here at Mazuma or someone else can help you know exactly what your tax bill is looking like and whether it's going to make sense for you to invest in something for your business and drive that income down. All right. So, and even if you get to this point and you know what your taxes are going to be, say you decide, well, no, I don't want to buy a piece of equipment, or I don't want to buy a new car, or I don't want to prepay my rent. At least you know what it's looking like now, right? Or even at the beginning of January, instead of April 15th or in April when it comes time that you actually have to pay the bill. So even if you may not be able to minimize taxes or you decide that's not your strategy, you can plan and prepare for those taxes. You've got maybe 3 months to sock money away and be ready to pay that bill. So yeah, there are the primary ways that you can save taxes coming up to the end of the year is fixed asset purchases like we've described, accelerating your expenses like prepaying rent, utilities, supplies, things like that. Retirement contributions. You set up a retirement plan of some kind that'll allow you to sock money away and get a deduction now for it. Those are the primary ways that people will be saving money heading into the end of the year. So hope that helps with that question. All right, next one. What is a SEP IRA? Great question. So a SEP IRA is a self-employed, I think SEP stands for self-employed pension program. And this is an IRA. You're probably familiar with the traditional IRA that allows you to contribute $5,500 per year per person into an account, and it's a savings account or I guess an investment, brokerage investment account that ideally grows for you through the stock market investing in mutual funds from year to year on into the future. When you put that money into a traditional IRA, you get a deduction now, and then you're taxed on it when you pull the money out down the road. And the government forces you to pull the money out at some point down the road after retirement. Okay, so that's traditional IRA allows you to put in $5,500 a year. A SEP IRA is special for self-employed people. All right, and this is a way that you can get more than just $5,500 into the IRA. SEP rules allow self-employed people to, in summary, put aside 25% of their compensation. Okay, so if I earned $30,000 as a net profit in my business, say I'm a sole proprietor here, then I'd be able to put more like $7,500 into an IRA that otherwise I'd be stuck at the $5,500 if I just had a traditional. But if I set up a SEP IRA, I could put $7,500 in this situation. All right, and of course, as this number goes up, my IRA limits, my SEP IRA limits go up, as opposed to the traditional IRA. It's just always $5,500. Unless you're over 50 years old, you can do an extra $1,000. Okay, so SEP IRAs are our most commonly recommended retirement plan. They just work the best. Some of the factors you need to consider is if you have employees, then they eventually become part of the SEP IRA program. And if you're contributing to your SEP, you've got to contribute to their SEP proportionally. Okay, so sometimes that makes it less desirable for the business owner. But a financial advisor usually is involved in setting up a SEP IRA, or at least a brokerage house of some kind that you can go online and you can set these up online, or you can go meet with a financial advisor that you know or that you've been referred to, and they can make sure you're aware of kind of the SEP rules. But it's a great way to get more money into an IRA than you would otherwise get to. The max contribution, so as this number climbs up, I said the limit climbs up too. I think it goes all the way up to $50-something thousand for the year. So you can get a lot of money into that SEP. One other note, if you are an S corporation, it's a little bit different in that this number does not cap the contribution. It's how much you take out as a W-2 wage that determines the maximum contribution if you are a SEP corporation, or an S corporation. All right, great question. Here we go. Next one, if it passes, will the proposed tax bill affect my 2017 taxes? Blanket statement is no. Generally, 2017 is pretty much in the books already. Everything that they're talking about changing of significance has to do with 2018 and beyond. So while 2017 wouldn't be affected, 2018, which is beginning in just a couple weeks, we could have a whole new paradigm under which we're operating. And there are a lot of changes that will affect everyone virtually. It's been difficult to classify a group of people all into one and say this group of people is going to benefit or this group of people is going to be hurt by this tax bill, because it not only has to do whether you're, for example, self-employed or not, but also do you have a family or not. So your personal situation, in addition to your income situation, is affected or factored in to how you're going to pan out, how it's going to pan out for you. But in general, it looks pretty much, if middle class family with small business income, I think most of the people are going to be fairly into a similar situation as they were in 2017. But it's really hard to tell, especially since they haven't passed anything yet. We don't know exactly what's going to be in that bill. So, but it's only something to look forward to in the future. Thank you. All right. Question here. How do I know how long it should take for me to break even or be out of the red as I start my business? Okay, that's a great question. And it's one that many small business owners need to know. So, you know, the type of business you're in and the industry you're in could determine, could factor in here. All right, if you're going into a market where people in general are spending, you know, in aggregate are spending millions and millions of dollars on the service or the product you're providing, then there's probably some standard rules that you could go by as far as measuring what other businesses have done who are in that same market or that same industry. But without, and that might help you know, okay, how am I doing compared to this business over here, who's in the same space as me, who's selling the same service or goods. But aside from that, we're kind of talking about a break-even analysis, all right? And to give you a little insight into how to determine what your break-even point is, we can do a quick example here. Let's say that in your business, we'll go to the pest control. Okay, so let's say you're a pest control provider, and you charge $100 per appointment. Okay, when you go out there and provide the service, you charge $100. And it costs you, let's say, $50 in labor. So maybe your employee, you have to pay him $20, and then it takes $30 worth of supplies and chemicals to go finish the job. All right, so altogether, let's say your cost of sales or your cost of goods sold is $50. Okay, we're kind of following this format here. That leaves us a $50 gross profit, but we'd also call that, in this break-even analysis, a contribution margin. Okay, how much does my gross profit contribute to covering the rest of my fixed expenses? Okay, so let's say this month we did one job for $100. It costs us $50 to actually get it done, so we have $50 left as our contribution margin, but we've got $1,000 a month in rent to pay. Okay, and let's consume all of it. Let's say that's all of our expenses. So our total expense is $1,000. Our net profit would be negative $950, right? We're $950 in the red. So the question is, how many jobs do I need to do before I can cover my expenses? All right, so if each job is contributing $50 towards covering these expenses, how many do I need to do? Well, 50 times 20 is $1,000, right? So if I do 20 jobs, then I should have enough to cover my expenses and break even. So let's run it out here. So let's say we do 20 jobs. So we get $2,000 because it's $100 we're charging for each job. We've got 20 times 50 is 1,000. So we got a $1,000 contribution margin, total gross profit. We've got $1,000 expenses, total expense is 1,000, net profit 0, broke even. Okay, so this analysis is exactly what you need to do in your business to tell how long is it going to take me? What are my direct expenses, my variable expenses? What are my fixed expenses? And what are my sales so that I can cover all of my expenses and break even, and then of course become profitable, right? If I do one more job over this, if I do 21 jobs, I'm going to do the calculation out, and I'm going to have a net profit of $50. So I hope that helps. That works with service-based businesses, or if you're selling, gift baskets or food or anything. It works for anything. The challenge for you is to put these numbers together, okay? And we can help you, get a bookkeeper or Mazuma, somebody there who can start tracking what your expenses are to maybe allow you do this analysis. All right? Okay. Well, I think that's all we have time for today. If you have any other questions, we're always willing to help here at Mazuma. Feel free to give us a call, shoot us an email. We hope you enjoyed the webinar, and do have a Merry Christmas and a great holiday season.